I think that over the next decade, we're going to be in what I call the 4, 5, 6 markets. 4% would be what cash returns. The Fed's not going to cut rates. They're going to hold them at around 4, and that's what money markets will churn out for the next several years. You'll have better years and worse years. 5% is what the average coupon is on the bond market, not just treasuries, but when you add in mortgages and you add in corporates, agency securities, the average investment grade yield is around 4.95, so call it 5%. I think that over the next several years, bonds will return you 5. You'll have good years and you'll have worse years, but they'll average 5. So 4, 5, and 6, where I come up with 6 is if you look at some of the stuff that Bob Schiller's done of Yale University with his CAPE ratio, cyclically adjusted PE, and that the Schiller PE is at 37. That is a very high PE number. Remember, we had a 22% gain in 23 or 25% gain in 24 that was powered by the Mag 7, and the market was really rich at the beginning of the year. And his work says at a 37 PE, you should see the stock market, just bottom line, it return you about 1% more than what the bond market's going to return you. So that's where the 6 comes in. Now, those numbers don't sound very good, right? Because like I said, we had 25% last year in the stock market, 22% in 23. Now we're talking about 6 going forward. So at the top line, I think that these markets are going to give you mid-single digit returns. It's not terrible because it's going to be above the inflation rate. I think the inflation rate is going to be, the camp is going to be elevated, and it's going to be 3. And money markets will return you 4, bonds 5, and stocks 6. And here's the big but. I think that we're going to transition away from buy the index goes up. And we're going to start thinking about themes, stocks, sectors, whether or not I want to be in growth or value, big cap, small cap, Europe versus US, emerging versus developed. How about financials versus energy versus healthcare versus consumer cyclicals? That's where you could get a lot of your money. If there's an environment that this might be closer to somewhat is the 70s. During the 70s, the S&P, I think, returned 4%. And in the 70s, inflation was 6, so you actually lost to inflation. But during the 70s, if you caught the energy trend right, if you caught the gold trend right, if you caught the consumer trend right, the banking trend right, there were 200-300% gains that could be made up and down. We've so gotten away from that, right? That everybody just buys SPY or sells SPY being the S&P index fund. Now everybody wants to know, when is the S&P going to go up? And the answer is maybe it doesn't, and maybe there's going to be themes within that or outside of that you could be playing. And the big problem with that is nobody's had to do that for a long time. It's all been just buying broad indexes and watching, the tide lift the boat. And now it's going to be a little bit more selective. And that's a different skill set altogether. And it's going to be difficult for people to start to transition to it. The easiest way to do it is, how do you do it? Is there are professional managers that do that kind of stuff. Right. And I think that a professional manager would probably be the best way to go if you were thinking that's the way that you want to be making money. What is Trump doing with tariffs and with all of this talk about Europe's got to pay for security and a sovereign wealth fund and everything else? And there is a method to the madness. And of course, maybe the execution is not being done properly. And that is, we are at an unsustainable period right now, that we've borrowed too much. We've got too much debt. It can't continue. Radical policy is what is needed. And he's offering that radical policy. And the retort I've always given is, okay, you could disagree with his radical policy. He's got it all wrong. Then give me another radical policy. Let's just go back to last year with $7 trillion budgets, $2 trillion deficits. Let's lift the debt ceiling and go to $40 trillion of debt. I actually think the bond market would sell off even harder, because we'd have to have treasury note auctions every other day because we'd be issuing so much bonds for that. We can't go back to that. So ultimately, you're right. We've got this problem, and this is what we're trying to address. One of the things that we're worried about is what the economic historian Neil Ferguson has pointed out. We pay more in interest costs than debt service. And he's pointed out that, and he went through for the last 200 years, that every empire, the U.S. is an empire, that has run into that problem, that they pay more in debt service than defense, they stop being an empire. And so we have to correct this situation that we just can't keep buying goods from foreign countries, sending them money, letting that money get recycled back into treasuries forever. We have to break that cycle. And that's what they're attempting to do. Now, are they doing it correctly? Maybe the answer is no, they're not. But the idea of trying to reduce our reliance on a huge trade deficit with a huge capital surplus that comes back to the U.S., that we fund it more domestically, getting Europe to pay more more to defend themselves so we don't have to, maybe realizing more assets in terms of a sovereign wealth fund. This has also been known as the Mar-a-Lago Accord. So what I'm arguing is, yeah, we do need to keep that in mind. And that's part of what is the bigger whole here that they're attempting to do. And ultimately in government and in business, there's always two things, right? Do you have the right idea? And I think they do. Are you executing the proper solution? That's the open question right now. The answer is yes, we are seeing a profound shift. I mean, if you look at the surveys of global fund managers and the like, they are moving their money to Europe and other cheap markets to degrees that we haven't seen in at least a decade, if not longer or so. And yeah, if the argument was that we were being supported by this ever increasing inflow of money from foreign sources into the US, now we're going to have to compete. And it isn't just so much that we're going to have to compete with Donald Trump can't be trusted and, you don't want to put your money in the United States. I'm sure there's some of that, but really it's more along the lines of what you said. We are very expensive and we have to rein in our government spending. They are very cheap. Their PEs are 10 or 12. Our PEs are over 20, 37 on the Cape. It's a little different measure. And their governments are about to start deficit spending where we're about to go the other way. That alone is going to get people pushed in the other direction. By the way, that's going to be a lot of government spending in Europe, and that's going to be inflationary because government spending is always inefficient. It creates inflation as well, too. So I think that that's really going to be one of the things you're going to have to think about as an investor is maybe we should be looking overseas. Maybe we should be thinking more international, or when you get that 401k list, maybe there's an international fund on it. But yeah, I think that these are some of the types of things that are going to go on. We refer to this as the end of American exceptionalism, which, by the way, I got to say it, I take great offense at that term because, that was a term that was coined 200 years ago about the American experiment being unique in terms of freedom and democracy. I know a lot of my European friends take offense at that term, thinking that we're superior. That term never meant that we were superior. So I always think of when they say the end of American exceptionalism as being kind of a shot that the entire American system is going to go away. No, it doesn't mean that. But to that point, I think people mean American exceptionalism, meaning that we are no longer going to be the dominant financial markets for returns. That, if that's what you mean by it, then I'll agree with it. Let me go with what Scott Bessent says about the dollar. He says that the dollar is the preeminent monetary currency in the world and it will remain its status as the reserve currency. Okay, fine. I agree with you. And I agree with you. It will remain its status as the reserve currency for all the argument that you hear people say the dollar is going to lose its reserve currency status. To what? There's $5 trillion that trade every day. World trade is done in dollars. What's the price of crude oil? It's priced in dollars. What's the price of gold? It's priced in dollars. Ask a European, what's the price of gold? They'll tell you what it is in dollars, and then they have to convert their currency. They have an extra friction step in there to buy gold or to buy oil. We don't. So what currency can do that if the US loses its reserve currency? The euro can't, the yen can't, the yuan isn't even a convertible currency. Cryptocurrency can't do that. Gold can't do that. But, as Bessent would say, the value could go down, and that's what's happening. Now, what's driving that could be very interesting right now, especially with what we've been talking about. The euro's been surging, the dollar's been declining against the euro the most. Now, part of that might be that flow we were just talking about, right? Get into cheap stocks, that's Europe. Get out of expensive stocks, that's the US. But also what's been happening is interest rates in the US have been going up, and European bond interest rates have been falling at the same time, which suggests get out of treasuries and get into European bonds. Now, who's doing that? In 2014, Russia invaded Crimea, and we wanted to punish Russia because they had $170 billion of treasuries held in the foreign custody account at the New York Fed. The next week, those $170 billion were transferred out of that foreign custody account, and a week later, they came back into that account as an increase in China's account. In other words, the Russians made a deal with China to hold their treasuries because we weren't going to sanction China. Now, why did I go through that? Because Russia and China learned we got to be careful because the U.S. can sanction us. So the last 10 years or so, China has made legal entities in Belgium and in Luxembourg to hold about $700-ish billion of their $1.4 trillion of treasury securities. The other 700 is held directly in China. So when you start seeing massive selling of U.S. treasuries, massive buying of sovereign bonds in Europe, come and the euro surging and the dollar falling, and you ask, who's the big seller of treasuries out of Europe buying European bonds? The answer is it could be the Chinese. And that's how they're doing it, which we can't sanction or put restrictions on those accounts. We'd have to ask the Belgians to do it or the Luxembourgs to do it, but they won't do it because they're mad at us over tariffs anyway. It makes more sense to me than saying that it's European fund managers that are selling treasuries and buying sovereigns. Oh yeah, there's probably some of that going on, but I don't think enough to see these dramatic moves in the dollar. So that's what I think is going to keep pushing the dollar lower. So I would argue, first of all, that we need to temper our expectations. You know, as a macro guy, everybody always turns to me and says, okay, it's a new year. There's going to be some multi-trillion dollar giant asset class that goes up 20%. Which one is it? What's the trade? And there's largely been one. You know, last year it was S&P, and that, no, the market's not necessarily going to be a disaster. We'll still come back from this a little bit, but, you know, it'll be kind of milquetoasty. And as long as it's above the inflation rate, which it will be, you'll be okay. We all want to have 20% gains, but we always don't get what we want. I think the Rolling Stones wrote a song about that once. And so we need to start to think in those terms. Now, bonds and cash will be a competitive alternative, right? Cash, as I said, will give you 2/3 of what the stock market will give you with a $1 NAV with no risk. Bonds will give you a little bit more with a little bit less risk. You know, stocks, I would argue, like I said, don't think like when's the S&P going to go up, but think about rotations. Europe is a place that you could definitely think about rotating to. Financials. Talk about a sector that's just gotten the shit kicked out of it for 25 years and has ridiculously low valuations. It's been financials and especially the banks. I mean, I've been one who's hated on the banks as much as everybody else, but then when I look at some of these bank charts, they're trading at the same levels they were trading at 20 years ago. You know, and the world has advanced in 20 years and their stock prices haven't. That's usually when you start to see some kind of value. So there might be something there. You know, there might be something coming in energy because they've gotten so beat up. Gold has obviously got the momentum going with it as well. I don't think it's too late to chase gold at this point, especially if you look at some of the miners and some of the junior miners, which have not kept up with the price of gold. But the bigger issue, as I wanted to say, was we haven't had to think about this stuff, right? We've always talked about S&P up, S&P down, you know, risk on, risk off. And that worked for a long time. But I think in this environment, we've moved beyond that to something that akin to, you know, was what we had in the 80s and 90s. When you started in on the year, you would look at the AI and you'd look at the Mag 7 stocks. And you'd say, man, these got extreme valuations. And then everybody said, AI is going to, you know, eat the world and we're going to redo the world and everybody's going to have to pay for this stuff. What was embedded in that assumption was, and the world wasn't going to have any issues. Well, now the world does have issues. And so I don't want to be owning very rich stocks. And one quick word about AI. The biggest stock of the 1920s was RCA, Radio Corporation of America. Took off on this new burgeoning technology called radio. Everybody was going to have one in their house. The stock peaked in 1929. I forgot the price level it peaked at, but it held. It did not take out that level again until the 1960s. Not only did everybody get a radio in their house, subsequently everybody got a black and white TV in their house, and half the country already had color TVs in their house by the time RCA made a new high in its price. Do not confuse that AI could be a transformative technology that could be change the way we do life, do work, do business, do schooling. And that's already in those sky high prices. And so while that happens, the price doesn't go up. You want another more recent example? 2000, we had the tech peak and we talked about the great things the internet was going to do. It did throughout the 2000s and into the 2010s. And it wasn't until 2013 that the NASDAQ eventually took out its 2000 peak. So you wound up saying everything that we hoped for the internet happened for 13 years and you didn't make any money. And so that's what you have to be careful of with these AI stocks, especially if we're in a period of transition, if we're in a period of less government, if we're in a period of a Mar-a-Lago Accord, which could cause a recession or something like that. AI can meet its promise. Doesn't mean that the stock prices have to keep going up. That, and it's all about the valuation, is why I'm worried about those stocks.